Last week I posted a video highlighting 5 REITs that are likely to hike their dividend later this year. The reality is that most REITs today are doing just fine because balance sheets are the strongest they've ever been and rents keep on growing at a rapid pace in most property sectors. But that doesn't mean that every REIT is worth buying. On the contrary, this is really a sector in which you need to be very selective because some REITs are poorly managed, others are over-leveraged, and then some own properties that are struggling, such as office buildings. This is why at High Yield Landlord we only invest in about 1 REIT out of 10 that we analyze, and in today's video I want to highlight 5 REITs to you that I think are likely to cut their dividend in the near term. Hey everyone, this is Yossi. I run a small investment firm that specializes in REIT investing, and before I get into the first company, could you please do me a favor and like this video? It really helped me a lot to grow this channel. Thank you so much. So the first REIT I want to highlight here is called Piedmont Office Realty Trust. It is one of the few office REITs to not have yet cut its dividend, but I think that its days are now counted. Quite a few office REITs have announced dividend cuts in the near term. First, SL Green cut its dividend by about 13%, then City Office announced a halving of its dividend, then Vornado Realty fully suspended its dividend, and all of these REITs are really struggling for the same reasons. Their properties are today struggling because the physical occupancy of their properties is still exceptionally low. They have to heavily reinvest in their properties to keep them desirable. Rents are dropping in some cases, leasing is slowing down, and now as a result of all of this, lenders are also becoming increasingly nervous. This is especially true now after Blackstone and Starwood recently defaulted on some of their office properties and returned the keys to their lenders. If even these private equity giants are struggling to pay off their office loans, it really sends a strong signal to the lenders that this sector has become very risky, and I suspect that it's going to make refinancing a lot harder for every office REIT. And so here's the issue for Piedmont. It owns attractive assets mostly in the Sunbelt markets, but it has quite a bit more leverage than the average of the REIT sector, and it also has a lot more debt maturities in the near term. I think that this is going to lead to a significant drop in its cash flow in the coming years as it refinances some of its debt at materially higher interest rates. Just recently the company announced that it had secured some new debt at a 9.25% interest rate, and it's going to use this to refinance some debt that had a roughly 4.5% interest rate. So that's a very significant jump in its interest expense, and so far its dividend has been sustainable, and if you look at its payout ratio today, it's quite reasonable even. But if now you account for the rapidly growing interest expense and at the same time the company has to reinvest in its properties to keep them desirable, I think that suddenly the dividend isn't going to be sustainable anymore and they're going to have to cut it. Then the second REIT I want to highlight here is called Blackstone Mortgage Trust. This is the mortgage REIT that's managed by Blackstone. It's particularly popular among individual investors because it's offering a roughly 11% dividend yield. But once more, I think that the cut here is quite likely because of 2 main reasons. Firstly, it's the REIT in its peer group that holds the most exposure to the office property sector. I'll put somewhere on the screen a table to show you this. And then secondly, combined with this, it's also the REIT in its peer group that has the most leverage. And I think that this combo of high office exposure and high leverage is really going to be a big problem for this REIT in the coming years. Blackstone has itself defaulted on some of its office property investments, and so I think it's quite likely that this mortgage REIT is also going to have to repossess some properties, then it's going to have to reinvest in them, and when you take all of this capex into account, its dividend isn't going to be fully covered anymore. Right now its dividend payout ratio is already quite high at around 90%, so there's very little room for error here, and with so much exposure to the office sector and so much leverage, I think that we are at high risk of a dividend cut here, and for this reason I will probably avoid this REIT. Then the third REIT is Brandywine Realty Trust. I think that the story here is a bit similar to Piedmont, which we highlighted as the first REIT in this video. It's an office REIT that has a bit more leverage than the average of the sector, and unfortunately for them, their debt terms are relatively short and they have a lot of it maturing in the next 2 years. I actually think that Brandywine is at an even higher risk of cutting its dividend than Piedmont because it's heavily exposed to Philadelphia, which is quite a bit weaker than the Sunbelt markets today. And then on top of that, Brandywine has quite a few development projects now on the way that it cannot simply abandon, and so it's draining some of its retained cash flow, and so its dividend coverage is relatively relatively poor already today. If you add to that some rising interest expense, I think it's very likely that we see the dividend being cut in the coming years. Then the fourth company is Dick Asset. This is a REIT-like entity that I actually own. I'm bullish on this company, but even then I think that the dividend cut is quite likely. The issue once more here is the debt. The company took on too much leverage in the years preceding the surge in interest rates, and so now they are forced to sell off some properties to pay off debt. But unfortunately for them, there are very little transactions happening today in Germany, and so it's very difficult to achieve that. Recently, the company announced that they had come to an agreement with the lenders to push their debt maturities a bit further into the future to win time to sell these properties, but unfortunately this is gonna come at a high cost. Interest rates are going to go up significantly on that debt, and so I think it's quite likely that the company is gonna decide to cut its dividend or even fully suspend it in order to prioritize debt repayment in the near term. But once again, I'm still bullish on the company. I'm actually hoping that they will fully suspend their dividend because it would reduce the financial risk of the company and position it for a stronger recovery. Then the fifth and final REIT I want to highlight is called Annaly Capital Management. This is one of the biggest and best known agency mortgage REITs. This is exactly the type of REIT that I've tried to avoid at all costs because their business model is too reliant on the direction of interest rates and the size of the spreads. These factors are extremely difficult to predict, especially in today's market, and therefore I think that the company is going to face difficulties in the coming years. If you just look at the company's dividend payment track record, I'll put a chart somewhere on the screen, you'll see that it's been very volatile. It goes up and down, and once again this is simply because the interest rate environment keeps on changing. They are not able to properly predict it in advance, and so this really shows you, in my opinion, that the business model is broken. They have cut their dividend quite a few times in the past, and I think that's very likely that we'll see another one in the near term. So once more, I want to emphasize here that it's very important to be selective in the REIT sector. Some REITs are today extremely compelling investment opportunities because their valuations are historically low and their cash flows keep on growing. But then at the same time, you have some other REITs that are severely over-leveraged, they own challenged properties, and perhaps their managements are misaligned with shareholders. Now, if you want to learn more about what I'm buying in today's market, feel free to join my REIT newsletter for a 2-week free trial. I'll put a link to it somewhere in the description of this video. And otherwise, once more, if you could like this video, that would really help me a lot. Thank you very much. See you at my next one. Bye-bye.